The second investment video that I made since restarting this channel was on Zscaler, the cloud-native zero-trust cybersecurity platform. I was interested in the business because they were revising their full-year guidance upwards. They did this for 3 consecutive quarters, and the stock looked at good value relative to other cybersecurity players in what is a very desirable industry. What I'm going to talk to you about today is what I thought of the earnings, and I will reveal whether I buy more Zscaler, whether I've sold some position and cut my losses, or whether I held what I already bought. So I'm going to give you the 2-minute summary now, and then I'm going to go into a deep dive of my findings and the reason why I made this decision going forward. So Zscaler reported very good results, 34% year-on-year revenue growth. That initial guidance was only 27 to 28%, so there was a massive beat. But what analysts were a little bit concerned by was the forward guidance. 19 to 20% on billings, 20 to 21% on revenue, and also not as much bottom line net profit as they would have liked to see. There was also some seasonality related issues where revenue was not growing as fast in the first half of the year and then caught up in the second half of the year. To summarize my strategy going forward, I've bought a lot more Zscaler shares. The company is now a larger position in my portfolio at about $160 a share. My original cost basis was $179. The stock is trading in a range between $160 a share and about $210 a share. I think the shares are fairly valued at about $210 a share, and that's why I'm buying more, and I will continue to hold them until they get towards the top of that range. Zscaler have historically sandbagged their guidance a lot, and I believe that they will grow faster than this 20 to 21% guided, and I will show you the numbers for that in a minute. They are in a fantastic industry. Cybersecurity is essential, and they're leading the way within the cloud market with their zero trust innovative products. One thing that definitely had some role to play in the stock falling in the subsequent days after the earnings was the fact that Zscaler went back to a net loss. Now, it was only a very small net loss of 15 million, but for the prior quarter, they'd actually reported a net profit of 19 million. So analysts were getting excited that, oh yeah, now like Zscaler, they're profitable on the bottom line of the income statement. And for this quarter, they went back to a net loss. Now, that doesn't bother me at all. It's not like Zscaler are burning through hundreds and hundreds of millions of dollars. You know, a net loss of 15 million on revenue of 600 million is negligible. And given how much they're spending on sales and marketing, they could easily make a net profit if they wanted to. In addition, Zscaler is not only free cash flow profitable, but they're actually close to optimizing their free cash flow margins. So like misses on the bottom line and not being completely profitable on the bottom line, you know, looking at EPS, that's not a big deal to me. What is a much bigger deal to me is revenue, right? That top line, that is the engine that feeds any growth company. And Zscaler, you know, growing in double digits, and not only double digits, but actually above 20%. It's revenue that is going to feed that growth machine. And historically, they have done very, very well. For a $20 billion company to be consistently beating on revenue by these margins are pretty high. So for this last quarter, Q4 2024, they beat by 4.45%, which is a very, very healthy beat in my view. As I said, analysts were also concerned with seasonality, and basically what happened, there was macro weakness in FY22, and that has reflected the level of renewals within a certain period during the year. Now, Zscaler CEO Jay Chowdhury explained this very well on CNBC, so watch this clip and he will explain thoroughly why we're seeing that seasonality within the year.
I think the market reacted to the fact that the first half growth was smaller than the second half growth. And the reason for that was simple. It's a historical reason. When in calendar 22, the macro got tightened, that was our fiscal 23 first half. That was a weaker first half. Those 3-year deals done essentially reflected in lower contract booking. That makes the first half small and the second half bigger. But the entire year is the same. I like to say you don't really judge the results of a football game on a quarterly basis. You look at the whole game.
Take another look at this. This is their first slide where they're saying, okay, for FY24, initial guidance was 27 to 28%, and now we actually smashed it and did 34% year-on-year revenue growth. Now, this slide started to think to me, there's actually a big difference between 27.5 and 34% revenue growth. It is a big difference when you're growing at these rates. So it made me think, how had Zscaler behaved with regards to guidance historically? Now, it's interesting because if you go back and if you look at fiscal year 2023, their initial guidance they set at the end of FY22 was 37% year-on-year growth. And when they actually came to the end of the year, they did 48%. Again, that is a really big margin. So all of a sudden, when I realized this, that it's Zscaler's culture to set really low guidance, completely sandbag it, and then raise it throughout the year, it made me much more comfortable hearing that 20 to 21% forward revenue growth rate. Now, I actually went back and looked at this on a historical basis. So if you go all the way back to the end of FY21, for FY22, they had guided 945 million, and then they actually did nearly 1.1 billion. So the difference was 21%. This was 21% better than the initial guidance, and that's a nominal beat of 145 million. The next year, the percentage difference was not quite as much, but they also did a nominal beat of over 100 million. So for FY22, from this nearly 1.1 billion that they actually did, they then guided for 1.5 billion and ended up doing just over 1.6 billion. And then for FY23, which was the slides that we've just seen, they did this 1.6 billion, guided for 2.06, and ended up doing 2.17. So again, there was a 6% difference, or a nominal beat of 110 million. So now they're guiding for 20% growth. This is roughly the midpoint of their guidance, right? This is their initial guidance. But like, what does that mean for this? Like, what are they actually going to do in terms of revenue? Because I mean, to guide this and then keep beating by $100 million, I would be very surprised if they grew not even any less than 20, but I mean any less than 22, and they have completely fallen off the train with regards to this pattern. So what I think is fair, what I think is reasonable, is to say, because obviously this difference, whilst it has been, you know, always beating, as you grow, as a company gets bigger, they can only beat on guidance by so much, right? So the pattern is 10, so 21, 10, 6, 4. So it's not quite halving, right? 4.2 is what I've put as my estimate from here, which would give them pretty much bang on 2,700 million or 2.7 billion in actual revenue. So that would be a nominal beat of just shy of 100 million. So they're beat by less, the pattern continues, but there's not as much percentage difference between their initial guidance and what they actually achieve. I think that given how conservative they've been and how much they've sandbagged it, this 2.7 billion is more realistic than the 2.6-ish billion that they are initially guiding for. And then when you plug these numbers into a base case DCF, so I've rounded this one down to 2,700, and then 3,250, 3,850, and then from revenue growth, scaling it from 18% all the way down to 14%. Bear in mind, you know, Palo Alto and Fortinet, they're making this kind of revenue at the moment, and they're able to grow in these kind of numbers. You know, Zscaler had very fast growth historically, but now the rate that growth is slowing down is starting to slow down, if you get what I'm saying. And then free cash flow, I mean, look, they just reported 27% margin. Very impressive. These are the analyst free cash flow numbers. And I mean, look, the probability of them getting to 30% free cash flow margin by FY27, I think is very high. This is what CrowdStrike have been sustainably at already. And Zscaler actually has higher gross margins than CrowdStrike. The difference being is that they spend more on sales and marketing, which is why historically their free cash flow margins have been lower. CrowdStrike's just a little bit more established, a little bit more mature in its brand, but Zscaler will get there. And as they bring down those operating costs, then they can really get to free cash flow margins of 30%. And look at this, 32% upside on the current share price of 160. I know I said 213 earlier, it's closer to 212 because I had to update the shares in issue, but that's really good upside for a cybersecurity play. As I said, this is like a real creme de la creme industry. Even if the world goes completely bonkers, cyber attacks are going to increase. They're going to be a part of war. So it's a very defensive industry. It's something that organizations have to spend on. It's something that organizations can't live without. And as I mentioned in my last video, go watch it if you haven't, Zscaler is a pioneer in cloud native cybersecurity solutions, which people need more than ever because so much, the cloud is growing, everyone is in the cloud, more people are working from home, and we're all operating in this ecosystem. The on-premise solutions are legacy platforms now, and we have a new way of making sure everybody is safe, which is much more secure than the conventional firewall. So I would very happily buy a lot of shares with 32% upside for a company like Zscaler because it's a leader in a really, really good industry, and it continues to post really good growth metrics. One thing I'll mention as well is that pattern that we saw in the last year of Zscaler constantly updating its revenue guidance, upward revising it. That happens, so I went through all the last quarters, and that happens like in every quarter in the last 12. So in Q1, Q2, Q3, of all of the last 3 years, they were always raising it. And then on the fourth quarter, they beat that final revenue guidance from Q3. So this is something that's happened historically. And there's no doubt in my mind that, when Zscaler come to their Q1 of 2025, they'll actually say, okay, we were going to grow at 2021, we're actually growing 22. And then the next quarter, they might say, oh, we're growing 23. So this has historically been a pattern, and it's just the way that it goes. The company likes to be conservative. And then this whole thing made me think, are management big shareholders? Because it seems like that they're trying to, not scare the market. They're trying to not have these exogenous shocks in the share price, which they actually did this time because the guidance was probably a little bit too low. But they're trying to not have these shocks so that, when they do then publish Q1, Q2, Q3, the market doesn't get too scared and it sort of bumps up the stock. So it made me think, how much do management own? And the founder, Jay Chowdhury, very, very smart man, founded Zscaler in 2007. I went on to the proxy filings and I found that he owns 27 million shares. And I was like, hang on, normal Zscaler shares, because Zscaler shares aren't cheap, right? At the moment, they're trading at $160 a share. And if you do 27 million multiplied by 160, you get over $4 billion of stock. But it's true, he owns over $4 billion of stock. So he has, it's actually about this percentage, 18% ownership of Zscaler, nearly a fifth of the company. So that is absolutely nuts. Now, he's not a young guy and he's not a poor guy. It's not the same as someone having all of their eggs in one basket, but for him to have 4 billion wrapped up in this company, that must be most of his net worth, right? He's not going to have a net worth of 50 billion. So he's got a lot of money tied up in this stock. And, maybe that's the thing that's sort of influencing, we don't want to, shock the market too much. And they sort of the stock took a bit of a hit for now. But I think as we get the Q1, Q2, Q3, and they get more confident that their full year guidance for FY25 is going to be much higher than that initial figure, and they raise it, then the market is going to have more confidence in the stock as well. Just coming back to valuation for a minute, if you look at Zscaler on a price to gross profit basis, they're now at 14 times gross. Pretty much the cheapest they've been. And I mean, this is really decent, 14 times gross, considering that realistically on the top line, we're going to probably see 23 to 25% revenue growth, given on how much they've historically sandbagged their guidance. Also on free cash flow, they're trading at 37 times. That's really, really good value for a company with this kind of growth in this kind of industry. This industry is always traded at a premium. A few months ago, before the CrowdStrike slip up, CrowdStrike was one of the most expensive stocks in the whole market, at least on a top line basis, price to turnover, price to gross profit. If we compare Zscaler and look at valuations compared to some of the others in the industry, you can see that it's on a gross profit basis and on a free cash flow basis. It's similar to Palo Alto and Fortinet. Now, these companies just haven't been reporting the same growth as Zscaler. They deserve a bit of a premium because they're larger, particularly Palo Alto is larger and it's not growing that much slower. But if you consider Zscaler is the market leader in zero trust, cloud native, and it's the innovative solution, they are trading at good value. And if you compare it to CrowdStrike are posting very similar growth numbers, but they're still trading at 26 times gross. I still think that CrowdStrike is expensive, particularly because they had this issue earlier on in the year, which, whilst it wasn't a major cyber issue for them, the update caused a huge amount of disruption and has damaged their brand. Yeah, so as I said, I've bought more Zscaler stock and it's now a very large position within my portfolio. I really like the risk reward at $160 a share. I like the cybersecurity industry. You know, I like the huge switching costs. I like the fact that it's solving a big global problem. One risk of buying a lot of Zscaler stock now is it's very well correlated with the S&P and the NASDAQ. You can kind of see, you know, you've got the S&P here in purple and the NASDAQ in red, Zscaler's in black. And you can see that typically it moves in the same direction, as you'd expect any stock like this too. And it's also more volatile than the index. So I know that the S&P and the NASDAQ are not the cheapest they've ever been right now. And if we do get another 10% crash in the indexes, that may mean that Zscaler comes down even further. But then idiosyncratically, Zscaler isn't as exposed to the wider economy than the average company in the NASDAQ 100. You know, I think cybersecurity has a bit more of a defensive element to it. So that can allow for an even greater buying opportunity. As I said, there could be some resistance around like this 160 range. The stock has sort of touched there a couple of times and then sort of shot up just above 200, where I think it is a fairer value. You know, considering the companies continue to grow and the shares are all the way down here at 160, it's definitely the best value that it's traded in a while. It probably hasn't traded much better since this period in March to May 2023, where it got all the way down to sort of $90 a share. So yes, I'm buying more Zscaler. It's not a short-term cash grab. This is a very sort of stable, long-term growth company. I would say that it's not the riskiest company in the world, but you do have to be prepared for volatility when holding this kind of stock. If you've got any questions, you can shoot them in the comments, and I wish you good luck with your investing.